In the personal finance corner of the internet, few topics generate more passionate disagreement than credit card churning. On one side, you have the churning enthusiast people who have turned the systematic pursuit of credit card welcome bonuses into a genuine side income stream, who fly business class internationally for pennies on the dollar, who have stayed in five-star hotels using points accumulated from cards they opened, collected the bonus from, and then set aside for their next application cycle. These people will show you spreadsheets, redemption screenshots, and detailed logs of thousands of dollars in annual value extracted from a system that most people participate in passively while leaving the majority of its value uncaptured. Both sides are telling the truth. And the reason this topic generates so much confusion is that both perspectives are describing real outcomes experienced by real people who participated in the same basic activity, applying for credit cards to capture welcome bonuses with dramatically different results. The difference between the success stories and the cautionary tales is not luck. It is a specific set of financial conditions, personality traits, knowledge, and discipline that make churning safe and profitable for some people and genuinely risky for others. Today, we are going to identify exactly which side of that line you are on, examine whether the rules and restrictions of 2026 still make the activity viable for people who do qualify, and help you find the sustainable middle ground that most people discussing this topic completely overlook. Welcome to Klux One Finance. Let us get into it. Credit card churning, at its core, is the practice of opening new credit cards, primarily or exclusively, to earn the welcome bonus, meeting the minimum spending requirement to trigger the bonus, collecting the bonus, and then either canceling the card after the first year to avoid the annual fee or downgrading it to a no annual fee product, before repeating the process with a new card. The income generated by this activity comes entirely from the welcome bonuses, which, as we have discussed in previous videos, can be worth $500 to over $1,000 each when the points or miles earned are redeemed for high-value travel or cash equivalents. The theoretical annual income potential of aggressive churning is real and significant. Someone who successfully completes 4 to 6 credit card applications per year, 2 to 3 for themselves and 2 to 3 for a spouse or partner, which the churning community calls two-player mode, capturing welcome bonuses worth an average of $600 each, could theoretically generate $3,000 to $4,000 in annual bonus value. Some experienced churners report significantly higher totals through more aggressive application pacing, manufactured spending techniques, and optimization of redemption values. The enthusiast communities are full of detailed trip reports describing business class flights to Tokyo, suite upgrades at luxury hotels, and cross-country first-class tickets, all funded primarily by welcome bonuses from cards opened during the previous 12 months. These numbers are real. The experiences are genuine. The people describing them actually did it. But the description of the outcome is not the complete story, and the parts of the story that get left out in the enthusiast communities are exactly the parts you need to understand before deciding whether this activity makes sense for you. Let us start with what churning actually does to your credit score, because this is the area where the most significant gap between enthusiast claims and cautionary advisor warnings exists, and where understanding the mechanics clearly is essential for making an informed decision. Every credit card application generates a hard inquiry on your credit report, which typically reduces your score by 2 to 5 points per inquiry. For someone applying for 4 to 6 cards per year, that is 8 to 30 points of inquiry-related score reduction annually, before accounting for the score impact of the new accounts themselves. Each new account also reduces your average account age. The more new accounts you open, the lower your average account age drops, which suppresses the length of credit history factor that accounts for 15% of your score. In the short term, an active churner with 4 to 6 new accounts opened in the past 12 months is typically operating with a credit score that is meaningfully lower than it would be if those applications had not been made. The magnitude depends on the thickness of the existing credit file. Someone with a 10-year-old credit history with 8 well-established accounts who opens 4 new cards may see their score drop by 15 to 30 points from the combination of inquiries and reduced average account age, settling at a new equilibrium that recovers as the inquiries age off and the new accounts begin accumulating history. Someone with a thinner credit file, 3 to 4 accounts, 5 or fewer years of history, who applies for the same 4 cards, may see their score drop by 40 to 60 points, potentially exiting the highest lender tier and affecting their ability to qualify for the best rates on other financial products. The enthusiast community's standard response to this concern is that the score recovers as the inquiries age off, which is true. Inquiries fall off your report after 2 years and lose most of their impact within 12 months. The average account age impact recovers more slowly as new accounts begin to accumulate age. But the recovery takes time. And during the recovery period, your score is lower than it would be if you had not churned. If you apply for a mortgage, a car loan, or any other major credit product during that recovery period, you may be doing so with a score that reflects the churning activity and that qualifies you for a less favorable rate than your underlying creditworthiness would otherwise support. American Express has implemented the once-per-lifetime rule for welcome bonuses on most of its consumer cards, which states that if you have ever received a welcome bonus on a specific Amex card, you are not eligible for the welcome bonus on that card again, ever. This rule applies even if you canceled the original card years ago and reapply fresh. For someone who has been churning for several years and has already received the Amex Gold welcome bonus, the Amex Platinum welcome bonus, and the Amex Green bonus in previous cycles, those cards are effectively retired as bonus sources regardless of how many years pass. The once-per-lifetime rule has significantly reduced the repeat bonus value available from American Express compared to earlier in the churning era. Bank of America has implemented what is informally called the 2-3-4 rule, no more than 2 new Bank of America cards in 2 months, 3 in 12 months, or 4 in 24 months. The cumulative effect of these restrictions is that the churning activity that was possible in 2015 or 2018, applying freely across issuers and earning multiple welcome bonuses per quarter without significant restriction, is substantially more constrained in 2026. Experienced churners work around these rules through careful sequencing, maintaining a detailed tracking spreadsheet of which cards have been applied for, when, and which restrictions apply to each potential next application. But the complexity of navigating all these rules simultaneously is significantly higher than it was in the era when most of the inspirational churning content online was generated. Additionally, the card issuers have become sophisticated about identifying and flagging churning behavior. Accounts that are opened, use just enough to meet the minimum spend requirement, and then immediately closed after the annual fee posts are patterns that risk management systems are increasingly good at identifying. Issuers have the right to claw back welcome bonuses if they determine the account was opened primarily to capture the bonus with no genuine intent of becoming a long-term customer. And they also have the right to flag cardholder profiles that show consistent churning patterns as ineligible for future approval. Being blacklisted by a major issuer, which is informal but real, can eliminate an entire product ecosystem from your future credit strategy permanently. Now let us talk about who churning is genuinely right for. Because despite all the restrictions and complications, regular purchases shifted to the new card temporarily, not through incremental spending generated specifically to hit the threshold. Fourth, they are organized enough to manage the operational complexity of churning. The spreadsheet of applications, the tracking of minimum spend deadlines, the calendar reminders for annual fee posting dates and product change or cancellation decisions. The monitoring of issuer rules and restriction changes. All of this requires a level of organizational discipline that many people underestimate when they romanticize the welcome bonus income without accounting for the management overhead required to capture it safely. Fifth, they have a clear strategy for what they are optimizing for. Churning for cash equivalents, cashback, statement credits, gift cards is a different strategy from churning for travel rewards, which is itself a different strategy from churning for specific redemption targets, like a particular business class route or a specific hotel property. People who churn without a clear redemption strategy tend to accumulate points across multiple programs that cannot be combined, in amounts that are insufficient for high-value redemptions in any single program, and that eventually expire or get redeemed at low values that make the entire exercise feel less rewarding than the effort invested. The people who should avoid churning are a larger group, and it is worth being specific about why. If your credit score is below 750, churning will likely push you out of the range where the best financial products are accessible, and the welcome bonus value does not compensate for the interest rate differential on any significant loan taken during the affected period. If you are planning any major financial decision that depends on credit within the next 2 years, the temporary score depression from churning creates risk that the welcome bonuses do not justify. If you have ever carried a credit card balance, churning creates additional credit lines that may be psychologically difficult to manage at zero balance, and that could contribute to debt accumulation that far exceeds any welcome bonus value. If you are still building your foundational credit profile and establishing your first or second credit card relationship, the account age disruption from churning significantly slows the credit building process by keeping your average account age depressed through continuous new account additions. The people who benefit most from long account age young adults building credit from scratch are exactly the people whose credit profiles are most damaged by churning. The sustainable middle ground that most content on this topic overlooks is what I call strategic bonus optimization rather than full churning. This approach involves applying for 1 to 2 new cards per year, specifically chosen for both their welcome bonus value and their long-term utility in your credit and rewards ecosystem. Rather than opening a card to capture the bonus and then closing or downgrading it as quickly as possible, you open cards that serve a permanent role in your reward strategy, adding a category that was underserved in your existing setup, contributing a credit limit that improves your utilization ratio, building an account that will continue aging beneficially for years. This approach generates meaningful welcome bonus income, 1 or 2 substantial bonuses per year, worth perhaps $700 to $1,400 in total, depending on which cards are chosen, without the score suppression of aggressive multi-card churning, without the operational complexity of tracking dozens of cards and restrictions simultaneously, and without the risk of issuer blacklisting that comes from patterns that clearly demonstrate churning intent. For the vast majority of people interested in extracting value from credit card welcome bonuses, this strategic 1 or 2 cards per year approach produces the best risk-adjusted outcome. Is credit card churning still worth it in 2026? The honest answer is that it depends entirely on which version of churning you are asking about and who is doing it. The aggressive version, 4 to 6 applications per year, navigating complex issuer restrictions, managing the score suppression, operating at the limits of what the issuers will tolerate, remains viable for the narrow group of people who meet all 5 of the qualification criteria we discussed, and who are willing to invest the significant organizational effort required to do it safely. For them, yes, the income is real and meaningful, and the restrictions, while more challenging than in previous years, are navigable with the right knowledge and strategy. For everyone else, which is most people, the answer is that the aggressive version of churning is not worth the risks and complications it introduces into a financial life that benefits more from the simplicity and stability of a well-chosen 2 or 3 card setup held long-term than from the complexity and credit score volatility of a continuous application cycle. The 1 or 2 card per year strategic bonus approach is worth it for almost anyone who meets the basic qualification criteria score above 750, no major loans planned in the next year or 2, genuine payment discipline. The welcome bonus income is real, the credit score impact is manageable, and the long-term utility of the cards selected makes the activity feel like optimizing a system rather than gaming a loophole. That is the version of this activity that we endorse at Klux One Finance, and it is the version that produces the best outcomes for the most people over the longest time horizon. Subscribe to Klux One Finance if you have not already. Hit the bell notification. Share this with someone who is thinking about diving into churning and needs the complete picture before they start. And I will see you in the next one.